Hi everybody, welcome to another WealthBee video. Today I'd like to talk to you about credit spreads, what they are and when to use them. And if you haven't traded credit spreads, hopefully you find this video helpful. Let's get started. Okay, of course we have to say that this isn't financial advice. Investing is risky, options are complex, and you should do your own research before making any decisions. Okay, credit spreads. Let's get started. What are they? Well, they're defined risk option strategies, meaning that you can't lose or make any more than a set amount of money. They can be created with either puts or calls, but not both. And they involve the purchase of one option and the sale of another option at the same with the same expiration, but at different strike prices. They can be used when you're either bullish or bearish on the market, and you receive a net credit for opening the position. Okay, I said they can be used with puts or calls, so let's have a look at some puts. So the put credit spread, which is otherwise known as the bull put spread, and that's because it's a bullish strategy and it makes money as the underlying price goes up. To build this, what we do is we sell a put option at a high strike and we buy a put option at a lower strike. In the example across on the slide, you can see that we've sold the 50 and we've bought the 45, and we've received a premium of $2. So this strategy profits if the stock price stays above the higher strike price at expiration, above $50. The maximum profit is the premium received, the $2, and the maximum loss, of course, is the difference between the strike prices minus the premium received. So that's the difference between the 50 and the 45 strike price, $5 minus the $2 received. Therefore, the maximum loss in this case is $3. Okay, that's the put side. Let's have a look at the call side. The call side is also known as a bear call spread, and it's a bearish strategy. It's something you would put on if you thought the market was going lower. And we would do that by selling a call option at a lower strike price and buying a call option at a higher strike price. In the diagram to the right, you can see that we've sold the 50 and we've bought the 55. And once again, we've received $2 in premium. So this strategy profits if the price stays below 50 at expiration, and the maximum profit is the premium of $2, and the maximum loss is once again the difference between the strike prices, the 50 and the 55, so that's a $5 difference, minus the $2 premium, making the maximum loss $3 as well. And you can see that in the diagram. Okay, so that's the academics of the strategy. I'll now show you how this looks like trading this live. Hi again. So here we are, as promised, over on my Interactive Brokers account. I've decided I'd look at doing a put credit spread on Microsoft because I'm bullish in the sense that I think this pullback's had a decent go. I don't think there may be much more to it. So what I'm going to do is go for the put credit spread because I'm more bullish than I am bearish at this point in time. I'm going to go 51 days out, and I'm going to put on about 25 delta. So I'll sell the 370 put and I'll buy the 365 put. So that means that my break even is going to be down around, we're looking at this, I can sell this for what, about $1.10, $1.15. So that'll put my break even about 368, or there, about 368.85 or something like that. Anyway, let's do that. We'll try to get a bit more for it, and we'll put that on, and let's see if we can get that filled. And 113. And bear with me.
Autofilled.
There we go. So that's filled at that. Now what we'll do is we'll import this in WealthBee and take a look at it. All right, hold on for that one. Okay, so now we're over in WealthBee. The trades have come in. We can see the trades. What we're going to do is book the trades and then analyze them in WealthBee and explain the payoff in terms of the live payoff of this strategy. So anyway, what we would do in WealthBee typically is we book these trades, and the way I book things is I book things into an open book until I've obviously completed the trade. I'll give it a position name, and once again I've got a standard for that, which is the underlying name, the date I've entered it, which is the 26th of March 25, and this is a put spread, credit spread really, credit spread. Okay, so we create that. I'm going to select the strategy, put credit spread, there we are. Okay, and we're going to save that. There you go, so that's booking that in WealthBee. Now if we can go over to the positions page, and what we'll do, actually I don't want the dashboard, I want the positions. Okay, so what we'll do here is we'll filter just for that Microsoft trade, and I'll show you that. Okay, you can see it here. Okay, so if we double click, we can see the two trades we made today. We sold them for $1.10, so we got $110 in credit. And if we look at the payoff chart, we can see the same payoff that you saw earlier in the PowerPoint slides. And you can see my maximum loss here is $390, and my maximum gain here is $110. You can see where the current price is. It's over here at $392. So, and you can see my break even is just around what, $386.85, I think it is to be exact. And you can see both the sold put there at $370 and the bought put there at $365. So that's a live example of the strategy I've just shown you, and it's also an example of how WealthBee can help you manage your trades and your positions. And that's pretty much it for this video. I hope that helps, and look forward to seeing you in the next. Thank you.